Thank you again for joining us. It's a great pleasure to talk about inflation and interest rates. I don't know how I can be excited about this topic, but this is probably the most dramatic time in my career for either of those things. And I am sure that you have a lot of questions and probably a lot of concerns. So it's a very timely topic, and we're excited to have an expert about it. To introduce our speaker is Peter Nash. Pete joined Doubleline in late 2016. He is our relationship manager. He has a BS in finance from the University of Illinois, an MBA from DePaul University. He is clearly a Chicago fan. I think he's in Chicago right now. And Pete, without further ado, I'm just going to hand it off to you to introduce our speaker.
Great. Thank you, Carl. I appreciate the very nice and kind introduction. You did hit it on the head. I am a Chicago guy through and through, and happy back in my hometown after moving around the country a little bit. So I'm really happy to be here speaking with all you today, particularly on this topic. And we hope, obviously it's timely, but we hope to provide some helpful insight to you. For those of you who aren't as familiar with our firm, Doubleline is an independent, employee-owned asset management company. We were founded in 2009 by Jeffrey Dunlop. And currently manage approximately $125 billion in client assets across both retail and institutional accounts. Our core competencies are really primarily centered around fixed income, both U.S. fixed income, global, emerging market fixed income, but we also work quite well on the equity side, commodities, and multi-asset. And happy to have with me today Mr. Ryan Kimmel. Ryan joined Doubleline in 2013. But more importantly, Ryan serves as an analyst on our multi-asset strategy. This is a team that helps really form the firm's top-down macro view, whether it be growth, whether it be from a Fed policy standpoint, interest rates, inflation, and the like. And of course, inflation being the hot topic for the last 12 months, and looking forward very well might be for the next 12 to 24 months. Hopefully that is not the case, but as it looks right now, that is certainly is. So, the topic today, of course, is to discuss where are we with inflation in the marketplace today. We're all feeling it, seeing it. What is Doubleline's view on inflation? What's really kind of driving this? And where do we go from here? And then what does it mean from an asset allocation or investment standpoint? So happy to have, again, Ryan with me today. And Ryan, I'll go ahead and kick it over to you. I know we've got some slides to go through, and then at the end, we'll have Q&A, as Carl said. So please come forward with any questions or thoughts that you might have and feedback, and we're happy to address that as best we can.
Sure. Well, thanks, Pete, and thanks, Carl, for having me on. Topic today that you asked me to discuss is inflation, and obviously it's top of mind for many investors, as the level of inflation is the highest we've seen in over 40 years, and it's the highest many of investors have experienced in their careers. So with that said, inflation is clearly becoming the most important variable in the Fed's reaction function at the moment, and it's in the driver's seat of driving monetary policy, and it has the Fed on a tightening course that is probably on the steepest, most hawkish path that we've seen in a number of decades. And our view is that as long as inflation is running well above the Fed's 2% target, which seems to be our base case quite comfortably, I think inflation and the path of inflation is going to be a key input not only for interest rates going forward, but also for equities and credit as well. So with that said, let me get into the meat of the presentation. I'm going to try and take about like 20 minutes to kind of go over, how did we get here with inflation, and then, what is our outlook? And then I think, we'll turn it over to Q&A and discuss how, our inflation outlook is feeding into our asset allocation. So with that, let me get started. So for us, we became constructive on inflation, with an outlook of inflation moving higher initially in the first quarter of last year. That was primarily due to the base effects from energy. We had very suppressed energy prices in 2020, and those numbers were going to roll off. And just mathematically, that leads to higher headline inflation numbers on a 12-month basis. But it became increasingly clear as we moved through the summer of last year that, due to the massive amounts of fiscal stimulus, the accommodative monetary policy, the economy was running very hot with a rapidly tightening labor market. And that was intersecting with challenges across the supply chain. So, upward shift in demand, combined with a restriction in supply, Econ 101 prices are going to go up. So let's dig into those concepts in a little bit more detail. So I'll start on the demand front. And on this chart here, this shows real disposable personal income, which is the blue line. And in the aftermath of the pandemic, or essentially in response to the pandemic, we saw about $5 trillion of fiscal stimulus being deployed into the economy. And that, to put in context, compares to about less than $2 trillion dollars deployed during the entirety of the global financial crisis. So multiples more than we saw during the last cycle. And of that 5 trillion, about 1.8 trillion went directly to households. And what you can see based on this chart is that this cycle was rather anomalous in the fact that during the recession, real disposable income actually increased dramatically. And typically during recessionary periods, income tends to decline, which is rather intuitive. And you give people money, and no surprise, they are going to spend it. And that's what you see on this chart here, which shows personal consumption of goods and services. And you see pre-pandemic, goods and services, the consumption of goods and services was essentially running kind of in line in trend. And then right in the aftermath of the pandemic, as you can see here, denoted by the red shading area, you saw a massive uptick in spending primarily on goods and particularly on durable goods, as consumers were essentially forced to shift their spending habits away from services towards goods, as we were all locked up in our houses during the peak of the pandemic. So what you essentially had was a significant, rather dramatic shift in the demand curve for goods. And that interacted with challenges to the supply chain. And I think this is where a lot of the people in the quote unquote transitory camp got it wrong. If you remember back to Q3, Q4 of last year, a lot of people are saying, yes, there are these challenges that we're seeing across the supply chain, some bottlenecks, but we think that the challenges are going to be, work themselves out. They're rather simple, and we should get back to normal over the course of a couple of months. But we were doing calls with logistical experts, shipping experts. And from those calls, it became very clear that it was a very complex issue with challenges on multiple points across the supply chain. I'm sure you remember seeing, the photos of, all the container ships that were parked off the port of Los Angeles. Well, that was just one component. There was also, no warehouse space or limited warehouse space to store the containers once they were offloaded off the ships. There was no truck chassis to put the containers on. And then there was a shortage of truck drivers to take those containers and ship them across the country. And it became very clear that this issue was going to take, many months to work themselves out. And that turned out to be the case. And, we're still experiencing these supply chain issues. And that combination of increased demand intersecting with a restriction in supply of goods led to these higher prices. And on these next two charts, I just have two kind of measures showing the supply move. This chart, this is a subcomponent of the ISM manufacturing PMI. This is the share participants that are reporting supplier delivery delays. And you can see that the share of participants were basically reporting that, it was a record level, record length of delays, where suppliers are having a very challenging time getting key inputs to manufacture goods. And that led to a significant drawdown in inventories. And this is a similar component. This just shows share of participants that are indicating that customer inventories are too low. And that went to the lowest level in over 30 years. And I'll just keep rehashing on the same dynamic. Increased demand, reduction of supply, prices are going to go up. And that's exactly what we saw. This is the most commonly quoted measure of inflation. This is the CPI, the Consumer Price Index. It's just a basket of consumer goods and services. And you can see the 12-month growth rate for the CPI basket is up over 8%, which is the highest level going back over 40 years. And it even surpassed our hawkish expectations. We were probably one of the more hawkish firms on the street, and realized inflation actually beat our estimates as well. And I'd say another element that a lot of folks got wrong last year was the fact, they were indicating that, yes, we are seeing this rise in inflation, but it's limited to a select, component of goods, due to the reopening of the economy, supply chain issues, but they're going to work themselves out. But the measures that we were looking at, like this Cleveland Fed 16% trimmed mean, which essentially removes the outliers, it was painting a different story. It was essentially saying that the rise in inflation was much more broad-based. And to us, that indicates that inflation will be a bit more persistent. So that's really a tale of how we got here with inflation. As far as where are we going, the most important topic of the discussion. So there's essentially two ways to basically develop an outlook on inflation. There's a top-down approach where you look at kind of like high-level macro indicators and try and identify how those indicators are going to feed through into underlying inflation. And then there's a bottoms-up approach where you essentially build up an inflation outlook from the different underlying components. And I'll start with the top-down approach. And I'd say the most fundamental top-down indicator would be just concept would be like the tightness of the labor market. And this is my favorite illustration of how tight the labor markets are right now. This chart shows US job openings in the black line versus the total number of unemployed workers, the red line. And the bottom line, the light blue line, shows the ratio of job openings to total unemployed. And what you can see here is that currently there's 2 job openings for every unemployed worker. And that's materially higher than the peak that we've seen in the previous 2 cycles, and indicates that the mismatch in supply and demand of labor is very large. And that is going to continue to put upward pressure on wages, which you can see on this chart here. This shows 3 different measures of wage growth, the 12-month change. And you see on all 3 of these measures, wage growth is the highest level in over 20 years. And the Fed is very aware of this. And I think this is one of the key fundamental drivers that they are trying to target when they're tightening monetary policy. The problem is monetary policy works on a lag and is going to take several quarters to feed through the real economy. So we're likely to see wage inflation pressures persist for some time. So that's the top-down approach. I'd say, obviously, from that point of view, inflation pressures remain to the upside. From a bottoms-up perspective, there's 4 key components of the CPI basket. There's the food component, which you can think of as like groceries or, the cost of eating out at restaurants. That's a 13% of the basket. There's energy, which is 8% of the basket. So just think like gasoline prices. Core goods, which is 22%. This would be like your apparel, your autos. And then there's the largest component, which is core services, which is 57%. And this would be, the largest component of this is like your shelter inflation. And I'm going to go through these 4 different components and identify where the inflation pressures are to the upside or to the downside. So I'll start with the food component, food inflation. And these are the 2 key components of food inflation: food at home, so groceries, and food away from home. That's dining out at restaurants. And both of these, and this shows the year-over-year growth. And both of these measures are at the highest level going back to the early 80s. And I'd say, looking forward, the pressure on prices on these 2 components are definitely to the upside over the near to medium term. On the food away from home component, wages, particularly in like the leisure and hospitality sector, are upwards of over 13% year over year, and I think that's going to continue to put upward pressure on the cost of dining out. I'm sure many of you have already experienced this firsthand with a bit of sticker shock when you get your receipt after dinner. And then inputs are also going up. On this chart here, the price of underlying agricultural commodities has skyrocketed over the last 3 years. The price of wheat, corn, and soybeans is up over 100%. The war in Ukraine has exacerbated the issue, as Russia and Ukraine are pretty large exporters of agricultural commodities. And the longer that the war kind of bleeds on, I think the larger the risk to the upside is that we could see more upticks in the underlying agricultural commodity prices. I'd say there's also another risk here, not just higher food inflation, but also a lot of developing economies. Food is a much larger component of the consumer's spending basket. And when you introduce food scarcity, that can increase the probability of social unrest in those regions. So it's definitely a factor to pay attention to going forward. So that's food. On the energy side, energy inflation has been skyrocketing. The year-over-year number of the official energy CPI is over 30%. This chart here just shows average gasoline price per gallon in the U.S. just under $5 when I took this snap, up from $2.50 at the beginning of last year. So prices nearly doubled. And the analysts that we speak to are indicating that the risks to gas prices are to the upside, especially as we enter the summer driving season. And I've seen some numbers thrown out there that gas prices could reach as high as $7 per gallon. In California, we're already seeing gas prices above $6 per gallon. So with energy, I'd say energy, the contribution from energy is already very high, but I think that the contribution to headline CPI from energy is going to remain positive as we go forward. So now let's take a look at the core components of CPI. So core goods and core services. I'll start with core goods, which is the orange line here. And as I discussed earlier in the presentation, as consumers shifted their spending habits to goods, and that interacted with the reduction in supply, we saw just a massive surge in the prices of goods. And you can see here the year-over-year growth rate for core goods was above 10%, which is truly anomalous because over the last 20 years, core goods tends to be a deflationary asset, meaning that the price of core goods tends to go down over time as the cost to manufacture goes down. I'd say The positive note, though, is that a lot of the pressures that we have been seeing, consumers have brought forward their consumption of durable goods. So we have seen a bit of a softening recently in consumption of durable goods. And also we have seen inventory levels being replenished. So I think on a forward-looking basis, the risk to core goods inflation is for it to head lower. One upside risk that I would highlight, though, has to do with the supply chain, and that China, with their zero COVID policy, have introduced very strict lockdowns across the country, which has put some pressure on many suppliers, and there is the risk that could slow down the improvement in the supply chain issues for the U.S. So that's an upside risk. And then the blue line here, this is core services inflation. It's been trending higher. It's just under 5% year over year. I'd say going forward, this is probably one of the more important components to watch, as this tends to be a bit more persistent. And this is one that the Fed is closely watching. So just to dig into the core component a little bit deeper, used cars and trucks inflation was a very significant contributor to the headline inflation number at the end of last year and beginning of this year. Used cars and truck prices were up substantially. This is one of the key pressure points from the supply issues: lack of semiconductors. There was a large restriction on manufacturers getting the parts needed to build their cars, and that led to significant price increases. But what you've noticed over the last couple of months is that the prices, the year-over-year changes have started to come down, and we think that given the replenishment in inventories, that the price of used cars and trucks could head lower over the coming months. However, on the services side, as I mentioned, shelter is the largest component in the services component, and shelter inflation is running near the highest level in over 30 years. And the pressures are definitely to the upside going forward, at least over the next couple quarters. As you can see here, home prices, as measured by the Case-Shiller 20-City Composite Index, are up 20% year over year. On a 2-year basis, home prices are up over 30%. So this is going to continue to put upward pressure on the shelter inflation. Real-time measures of rent, as measured by the Zillow Rent Index, are up over 16%. And these real-time measures tend to lead the official shelter inflation data. So I think it's pretty clear that there's going to remain upside pressures on in shelter, and that is going to feed through into higher services inflation. So when you basically sum up all the components, food inflation, you have upside pressures. Energy, I think it's going to continue to be a positive contributor to headline CPI. Core goods, I think we're going to see some alleviation and pressure there, but that's going to be offset with core services, which should continue to edge higher. So net, I think that's a positive upside risk to the headline inflation data going forward. Now let's look at some expectations. This chart here, this shows consumer inflation expectations based on the University of Michigan Consumer Sentiment Index. You can see that while short-term 1-year forward inflation expectations are near the highest in over 40 years, the long-term inflation expectations, that the 5 to 10-year expectations, are still anchored. So that's a positive. At least long-term expectations are anchored. They're still within their 20-year range. And I think that shows a confidence that the Fed can rein in inflation eventually. This is the Fed's favorite measure of quote unquote structural inflation. This is the 5-year forward inflation rate expectations. And what you can see here is that it's still at 2.3%. It's still within the essentially 20-year range, which is another metric that shows that the market has confidence that the Fed can eventually rein in inflation. If this metric started to edge higher and broke above 3%, that would definitely raise some warning flags, as the Fed would probably have to get even more hawkish than they currently are. And I think that would have pretty adverse impacts on risk assets.
Hey, Ryan, real quick, can you explain what is the 5-year forward?
Sure. So it's in 5 years' time. What is the 5-year inflation expectation? So what it does is it essentially removes the front end impact of higher inflation, right? So like if you just took, say, the 10-year break-even inflation rate, that has a very large hurdle, and it is essentially kind of it's not indicative of structural inflation, because the front years of that are higher, right? Because the starting point is over 8%. And as you trail down lower, I think the next chart's actually kind of good to show that. See, as you trail lower, that is going to basically support your 10-year break-even inflation rate, where the 5-year takes out the kind of your front end inflation numbers. Does that make sense?
Yeah, thanks.
And this is the last chart I have in the packet. So, what are the market participants expecting for the path of inflation? The red. So this shows the year-over-year CPI basket. The realized number, you see up that 8.3% currently. And the red dash line shows Bloomberg economist forecast going out to 2024. And they expect inflation to head up pretty dramatically lower to about 3% by the middle of next year. And then market implied inflation expectations, this is just based on inflation swaps, a little bit slower decline in inflation, and they essentially have inflation kind of like plateauing out around 3 to 4% over the long term. I will mention though that on both these measures, inflation is expected to be well above the Fed's 2% inflation target. And then for us, just to give you some context, for us, we do think that the March print, it was likely the high for this cycle in headline inflation. We do have some pretty significant monthly numbers rolling off that will put some downward pressure on the headline number going forward. But given some of the structural issues, the tightness of the labor market, the lag of Fed policy to filter through the real economy, we think instead of seeing this like steep decline in inflation, you're going to see this plateau where inflation is likely to remain above 6% for well into 2023. So I think that'll keep the Fed definitely on this hawkish path going forward. And if I had to choose taking the over under on how many hikes the Fed implements over the next 12 months, I think I would take the over on that. So with that, just to summarize, the risks to inflation are to the upside based on both top-down and bottoms-up approaches. We think that inflation is going to probably head lower, but it's going to be a lot slower decline than what the market and economists are forecasting.